Welcome to the Northbound Wealth Podcast. All opinions expressed by me, my co-hosts, or my guests are solely our own opinions and do not reflect the opinions of Northbound Wealth Management. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, and tax advice or as a solicitation to offer or buy any securities. Clients of Northbound Wealth Management may maintain positions in the securities discussed in this podcast. Hello, everybody. Welcome to the Northbound Wealth Podcast. This is your host, Brent Foster, founder and CEO of Northbound Wealth Management. And let's dive into the monthly market insights, December 2023. We are going to talk about the U.S. markets, the global markets, some performance. We're going to talk about the S&P 500 a little bit later and the top performers, the worst performers there, some of the positions that we hold at Northbound Wealth Management a little bit, and then also highlight a few other things. So let's dive in. U.S. markets. So stock prices surged last month as positive inflation data and falling bond yields emboldened investors. The Dow Jones Industrial Average gained 8.77%, while the S&P 500 advanced 8.92%. The NASDAQ composite, which led all year so far this year, has picked up 10.7%. Absolutely ripping, guys. Absolutely ripping. So inflation eases, bond yields fall. So the fears that have dragged on the stock market since August evaporated in November as fresh inflation data reaffirmed continuing progress in the fight against rising prices. The good news on the inflation front, coupled with upbeat comments by Fed officials, helped drive bond yields lower. Additionally, the bond market was relieved following news that a 20-year Treasury note auction was well received. So the CPI report sparks a rally. The October's Consumer Price Index, or CPI report, was released mid-month, showing prices flat from the previous month and a cooler than forecasted core CPI, core CPI excludes food and energy. Stocks surged with the S&P 500 index rising 2.9%. The yield on the 10-year Treasury dropped 19 basis points, which is a huge one-day move. So the rate hike cycle ending, is it really ending? The combination of decelerating inflation, constructive economic data, and generally benign commentary from the Fed officials over the course of the month generated an increasingly optimistic outlook that the Fed's rate hike cycle may be at its end, and the prospect of a rate cut sometime in the first half of 2024. So solid corporate earnings reports, but cautious on outlooks. There's a ton of companies coming out with outlooks, and it seems like it's earlier and earlier every year. But corporate earnings were also a key focal point in last month's stock market actions, with 94% of S&P 500 companies reporting. 82% reported a positive earnings surprise, while 62% reported a positive revenue surprise. On a more cautionary note, 64 S&P 500 companies issued negative earnings guidance for the fourth quarter, while 32 issued positive guidance. With powerful gains already registered for the month, investors took a breather in the final week of trading to digest November's exceptional gains. Sector scorecard. So for the month, in November, all industry sectors except energy, which was down 0.72% or 72 basis points, ended higher, including communication services, which was up 7.8%. Consumer discretionary was up 10.97%. Consumer staples was up 4.13%. Financials was up 10.94%. Healthcare, 5.4% to the positive. Industrials, 8.83%. Materials, 8.35%. Real estate was up 12.48%. Tech was up 12.90%. And utilities were up 5.14%. Absolutely awesome. Awesome. Felt good to see that. So a recap for the November 2023 U.S. markets are concerned. Here we go. S&P 500 up 8.92% for the month. Year to date, that's up 18.97%. The NASDAQ was up 10.70% for the month, guys. That's up 35.92% on the year. That's phenomenal given the S&P and the NASDAQ rallying that much after what was the 2022 demise. So making up for those losses in 2022. The Russell 1000 up 9.13% and for the month of November and up 18.79% for the year. The 10-year Treasury note was up 4.35% for the month. So that's where that rally came from in the Treasury market, the bond market. And that means on the year, 0.47% to the positive, erasing losses. A lot of this data is derived from Yahoo Finance through the end of November, November 30th, 2023. So what investors may be talking about in December. Now we're the 7th day into December. And investors' attention is expected to shift to the 2-day FOMC meeting. So the Federal Open Market Committee, the Fed, which ends on December 13th. So that's still, we got another 6 days before the end of that. The focus may be less on the actual rate decision on whether to raise rates, keep rates flat, or reduce rates. But since the market expects the Fed to maintain the federal funds rate at its current level, instead, investors may pay close attention to the wording of the FOMC statement announcing the decision, and most especially to Fed Chair Powell's remarks in the press conference that will follow up on the meeting. Following the November meeting, Powell said that the Fed was not convinced that the inflation battle had been won, and that additional progress towards its 2% inflation goal may require further restrictive monetary actions, which basically means raising rates. The news unsettled investors who had hoped that the rate hike cycle had come to an end. While Powell is unlikely to change the stance of his message, investors will be looking for any indication that his stance has shifted. All right, on to world markets. The MSCI EFA index gained 9.09% in November on moderate inflation and hopes of interest rate cuts. European stocks performed strongly with advances experienced in France, which the French market was up 6.17%. The Germany or the DAX was up 9.49%. Italy up 7.19%, Spain up 11.54%. The UK lagged a bit, picking up only 1.80%. The Pacific Rim markets also saw solid gains, with Japan rising 8.52%. Hong Kong was the performance outlier, falling 1.65% as China continued to struggle. So a world market recap for November of 2023. It's always good to go over. Actually, what I'll do is I'll talk about the year-to-date performance just to speed this up. The year-to-date performance of 2023 through the end of November. So Hang Seng China was down 14.92%. So they continue to struggle. They're the outlier struggling area. The Kospi or Korean index was up 13.36% on the year. The Nikkei in Japan was up 28.33% for the year. The Sensex, which is in India, was up 10.10% for the year. The EGX 30 or Egypt's market up 69.44%. Bovespa, which is Brazil, was up 15.51% on the year. The IPC All Share Mexico Index obviously is in Mexico. Mexican stocks up 11.55%. ASX 200, which is Australia, flat, basically up 0.69%. So really not performing that great. Let's go on to Europe. DAX Germany up 16.46% on the year through November. CAC 40, which is the French market, up 12.93%. IBEX 35 in Spain, 22.23%. FTSE 100 UK, which is the United Kingdom, flat, 0.03%. And the IT 40, which is Italy's index, 25.44%. A lot of this data, again, derived from Yahoo Finance through the end of November. So indicators, let's go on to the U.S. and take a look at the U.S. economic indicators, gross domestic product, GDP. So that number came out. The second estimate of economic growth in the third quarter was revised higher from 4.9% to 5.2%. How about that for growth in the U.S., despite all of its challenges? Employment. So employers added 150,000 jobs in October, below September's pace of 297,000 job gains and the consensus forecast of 170,000 new jobs. So kind of came in lighter than what was expected. The unemployment rate ticked higher to 3.9%, while average hourly earnings came in around expectations. So nearly 4% unemployment rate. So we're kind of trending higher. So that means the job market's softening a bit. Retail sales, consumer spending declined 0.1% in October, coming off a 0.9% increase in September. This was the first decline in retail sales since March. Year over year, retail sales rose 2.5%, below the level of price increases for that period. Industrial production. Industrial output fell 0.6%, owing in large part to the strike by the automotive workers. The decline was greater than the 0.4% that the economists had been expecting. Housing. Housing starts rose 1.9% in October as builders took advantage of the ongoing shortage of existing homes resale inventory. Sales of existing homes declined by 4.1% month over month to a 13-year low. Yeah, nobody's selling homes. Why? Rates are too high. People can't move. While sales from a year ago were down by 14.6%, the year-over-year gain in the median sales price was 3.4% due to the low inventory of homes on the market. New home sales fell 5.6% in October, though they were higher from a year ago by 17.7%. Okay, inflation, CPI, we did talk about it a little bit earlier, but let's revisit this. Consumer prices were flat in October and were higher by 3.2% from a year ago. Both numbers came in below Wall Street expectations. Core CPI, which excludes food and energy, also posted below forecast results, rising 0.2% in October and 4% year over year. The annual core CPI increase was the lowest in 2 years. Durable goods orders. All right, so orders of goods designed to last 3 years or longer. Think about that. Orders designed to last 3 years or longer slumped 5.4% in October, led by a sharp decline in aircraft and automobile sales. By the way, Boeing has a massive backlog. I don't know why I want to say this, but of like 5,000 planes. It's crazy. Anyway, I like the stock right now. The Fed, the FOMC elected to leave rates unchanged for the second consecutive meeting. The committee's accompanying statement pointed to an improved assessment of the economy. In his post-announcement press conference, Fed Chair Powell said that bringing inflation to the Fed's 2% target was a long process, leaving open the possibility of a rate hike in December. So we'll see about that on December 13th here in about 6 days. Most likely my next podcast release will be after that, so that I can kind of capture what's going on there. So by the numbers, here's some fun facts. The holidays, which, hey, I hope you guys had a great Thanksgiving heading into the final month of the year, less than 30 days. We've got Christmas and New Year's and a lot of vacation time with family. I hope you guys all enjoy that. But here's some fun stuff about holidays. Here's a number between 6 and 10. That's the number of gifts purchased on average. It's between 6 and 10. 11%, that's the number or the percentage of people buying more than 20 gifts. So only 11% of folks buy more than 20 gifts. What are the most popular gifts, which is a great question. Number 1, gift cards. Number 2, clothing and accessories. And number 3, books and media-related gifts, such as computers, tablets, and phones. So how about one of the most expensive gifts? A rare Cartier diamond tiara was the most expensive item in 2022's Neiman Marcus Christmas catalog, and it's valued at $3.2 million was the cost of that particular tiara. So we'll see if that record gets broken this year. 1935 was the year the tiara was created. There's 612 diamonds in that tiara. Amazing. And check this out. Here's a fun one. Atari 5200. My folks might know about this. I think my dad actually had one, and we played it when we were young in the 80s. One of the top holiday gifts in 1983. It was an Atari 5200. The cost was $199.99, and the amount of RAM in an Atari 5200, which is mind-blowing, was 16 kilobytes. Holy cow. I don't even know what an NVIDIA chip can do, but it's insane the amount of computing power we have these days. All right. So, since we're just beyond the first week of December, some of the data I shared about November has changed a bit. The Dow is up 9.35% for the year. The Nasdaq's up 36.67% for the year. The MSCI EFA index is up 9.31% for the year, and the S&P 500 is up 19.67%. And the 10-year note it closed at 4.22%, which is up a little bit of 0.34%. So overall, the continuation of this bullish pattern is and trend is happening, and we're getting that year-end rally, which is expected and pretty typical. So this week, key economic data, we've got factory orders, ISM surveys, and JOLTS report, ADP report, jobless claims, and then consumer sentiment and the employment situation report this week. So we'll continue to track that. And into next week, we've got notable companies reporting earnings. This week we've had, AutoZone, MongoDB, Broadcom, and Dollar General. And this week's tax tip of the week is: did you know that if you're receiving Social Security benefits, you may have to pay federal income tax on a portion of these benefits? For those of you who are actually drawing Social Security, you know this, but those of you who haven't, you need to be aware of it. The question is, are Social Security benefits taxable? Yeah, they are. The amount you have to pay may depend on your specific income and filing status. To find out whether your Social Security benefits are taxable, if you are single, take 1/2 of the Social Security money you receive throughout the year and add it to your other income, which includes pensions, wages, interest, dividends, and capital gains. If the total comes to more than $25,000, then part of your benefits may be taxable. If you are married and filing jointly, take 1/2 of the Social Security money you receive throughout the year and 1/2 of your spouse's Social Security benefits and add both of those amounts to your combined household income. If the total is more than $32,000, part of your benefits may be taxable. On its website, the IRS lays out the percentage of benefits that are taxable based on the calculation that I just shared. These percentages vary between 50% and 85% and depend on your filing status and income levels. For example, if you're filing single with $25,000 to $34,000 in income, 50% of your Social Security benefits may be taxable. And again, this information is not intended to be a substitute for specific individualized tax advice. We suggest you discuss your specific tax issues with a qualified tax professional. This tip was adapted from irs.gov. On to the next and final segment of this podcast. Hey everybody, this is Brent Foster. I'm going to go over performance of the S&P 500 year to date. And then also we're going to go through the underlying holdings of the index and check out the weights of the index and what kind of drove that performance. And then what companies are really standouts for 2023 and carry momentum into next year. Also, we're going to go over the worst performing stocks. And so that ought to be interesting. So Northbound Wealth Management, we actually hold a lot of the top stocks in the index: Microsoft, Apple, Amazon, Google. Of course, there's many more: NVIDIA, Tesla, JP Morgan, all kinds of companies. And so let's talk about some of the attributes of performance this year. It's been fun. It's been a good year. The S&P so far is up nearly 20% on the year, which is awesome. The top holding as far as weight in the index is Apple. Apple holds the pole position of portfolio weight in the SPY, ticker symbol SPY, which is the S&P 500 index. of 7.41% of the index is held by Apple. All right, Microsoft holds the second position at 7.21% of the index is Microsoft. Amazon third, and it drops down quite a bit from 7 down to 3.48% of the weighting is in Amazon. Nvidia has climbed to 3% of the weighting of the S&P. Google holds the 2% spot. Meta is at 1.84%. Actually, let me correct that. If you actually add the two share classes of Google, so GOOG and GOOGL, you got to add 2% and 1.74%. So you combine those two, and really, Google's the fourth spot above Nvidia, maybe even the third spot above Amazon, depending on the day, because these stocks all move around each day. Moving on, Tesla has a spot of 1.72% of the index. Berkshire Hathaway, 1.69%, and Berkshire stock's done well. UNH or United Health is 1.33. Eli Lilly has 1.22% of the index, and it's done extremely well with Ozempic coming out and being a blockbuster drug. JP Morgan Chase at 1.2%, Visa at 1%, ExxonMobil at 1%, Avagio, or formerly known as Avagio, AVGO, which is now Broadcom, at 1%, J&J, Johnson & Johnson, nearly 1%, Procter & Gamble at 90 basis points, or 0.9%, MasterCard at 8.89%. Let's see, the Home Depot, 0.85%, and Adobe at 0.72%. All right, so there you go. There's some of the top holdings in the S&P 500. Let's talk about how they performed. So year to date so far, Apple, man, they've done well. They're up 48.02% for the year. That's substantial given the weighting of the S&P 500. Now you see the attribution in the nearly 20% return of the S&P 500 this year so far. Big weight to Apple and Microsoft. So Apple is up 48.02, Microsoft up 53.78%, and then Amazon at 72.05%. Those three up substantially, and Alphabet up 47.36%, or, Alphabet is the parent company of Google. So basically think Google. So if you look at those top four spots, I mean, that's a great recovery from 2022's performance of the S&P 500 being down nearly 20. So you got NVIDIA, by the way, has just crushed it up this year, 211.37% year to date. And that was as of market close yesterday, which was December 6th. So nearly the entire year, all these companies are doing quite well. So technology has been a highlighted spot as far as making sure you're allocated to tech. That's why, because you can have these runs that are pretty awesome. All right, Meta Platforms, which is Facebook, up 163.79%. Now, we have to remember with some of these companies, they had just massive drawdowns and not doing too well. Like Meta, for example, just didn't have a great year in 22. And as it was trying to figure itself out, Zuckerberg finally got with the program and cut his spending and headcount and shifted the company back to what their core competencies were. And when he did that, the street liked it and people started coming back to the stock. As a firm and personally, I just haven't owned it. That's the one stock I haven't owned. All the rest of these I have in portfolios. Tesla is up this year 94.33%. Berkshire Hathaway up 14.08%. United Health up 3.65%. So Berkshire and United Health had great years, and as far as last year is concerned, the year before that, but then if they're doing fine, and they're just in a defensive area of the market, and that's where value players live, or value investors live. And this year's been a switch back to the growth story. So What's nice is if you own the index or that you've done actually quite well. So you're not going to be at the top, you're not going to be at the bottom, but you're going to be somewhere in the middle upper range actually. Eli Lilly year to date up 61.07%, JP Morgan up 16.56%. That just shows you how much financials and defensives have lagged this year, and the appetite went to risk on, and people shifted money from value to growth. And then now, who knows what 2024 is going to look like, but it's a good idea to probably just own all of it to some degree or another. Maybe not 100% of all of it, but talk to your financial professional about that or talk to us about it. Let's see. Visa is up 22.4% for the year. ExxonMobil, this is a space, the energy space lagged this year, started to sell off this year. So keep that in mind. Energy for Exxon down 10.15% for the year. Broadcom and semiconductors is up 61.62%. So you can see you're starting to see a couple of areas, energy, and then I'll get to pharma. Certain types of big pharma are down too this year, like Johnson & Johnson down 11.34%. Procter & Gamble, household products down 3.24% on the year. MasterCard up 18.02%. So the consumer seems to be doing fine, and MasterCard's doing well. Visa's doing well. The Home Depot up 3.25%. Nothing to write home about, but still positive on the year. I think the spending for the consumer kind of slowed down we've had several years to remodel our homes, right? So we need the housing market to pick up and home sales to start happening again, but that's not going to happen until interest rates go back down. And then you'll see consumers go out and start to spend more at, say, Lowe's and Home Depot and Tractor Supply and all these other places that you might need the stuff that you need for your new property or a rehab or whatever. So, all right, Adobe software. Adobe is up 77.01% for the year. So also an indication of where things are headed with AI and with software and technology and innovation in that space. AI, I think everybody is now talking about AI. And if you don't talk about it, you're going to be left behind in this move in artificial intelligence. It's going to impact everything. So a couple other companies we'll go over. Costco year to date's up 33.06%. Merck down 4.79%. Chevron down 20.59%. AbbVie kind of pulling back some at down 9.42% for the year. So what you're probably hearing is big pharma and energy took a back seat to a lot of software. Here's Salesforce up 87.9% for the year. Okay, Pepsi, Coke, both down about 7.28 and 7.88 respectively. Again, staples, defensives taking a back seat this year. Walmart up 8.64%. Nothing to write home about there, even for Walmart as well as they do, but they're kind of in the consumer staples, merchandise, retail, and so they're kind of weighed down a bit by some of that staple type of mentality and spending. Accenture, which is IT consulting, up 25.70% for the year. Bank of America down 7%. So financials, again, just not doing too hot this year. So there's a review of some of the largest companies doing in the index. A lot of them doing well, and a lot, and some of them not doing so hot. It was kind of a joke. The Magnificent Seven, which is talked about a lot. People like to describe the Magnificent Seven. That's the top weights in the S&P 500 that are performing the best, and it happens to be big tech, right? Apple, Amazon, Google, those types of companies, Microsoft. So anyway, that's a good thing to hold those companies that you've owned for a while. The attribution to your portfolio over a long period of time is really good when that happens. But also know that those can pull back as well. They don't always go up, and it's not a straight line. Investing is not a straight line up and to the right. There are up years and there are down years, and there are years where there's kind of So keep that in mind as we move forward into 2024, 25, 26, and 27 through the end of this decade. All right, so let's talk about 2023's worst performers. Well, Solar Edge Technology. So they're down 71.52%. M-Phase, which is semiconductor materials and equipment, down 59.7%. Fertilizer and ag chemicals, FMC, was down 55.76%. Moderna, which is a biotech company, was down 55.13%. Let's see. The Estee Lauder Company's personal care products down 46.25%. Dollar General, which is consumer staples, again, down 45%. Albemarle Specialty Chemicals down 45%, and Pfizer was down 43.81%. And let's keep going with this list just for a couple more here. Illumina, Walgreens, Paycom, we're all down 40 to 43%. The AES, or a power energy company, Insulet, which is healthcare. There's a company, Revity, which is a life sciences. So some of these are chemicals, pharma. They're all down. There's like Sealed Air Corp, VF Corp, Etsy, and Insight. All these guys are down 30 to 40% for the year. So we want to see more and more broadening out of these companies reporting earnings, doing well, and you'll see the follow through of that hopefully in 24. If we don't have other companies participate in the gains, there's only so much that the big cap tech can do to carry the index for the foreseeable future. You're going to have some broadening out and some other companies doing well in order for the index to go up. I guess that's my opinion. It doesn't have to happen. I guess the others can, the Magnificent Seven can just carry the index into perpetuity, but I don't think that's the case. I think that you've got to have a reset and a reevaluation at some point. And Jamie Dimon and other people are talking about how, things aren't as great as they seem because there's not enough participation out there. So in the markets. Anyway, Northbound Wealth Management, I feel like we've done quite well in celebrating better performance, good performance this year, and excited about what next year is going to bring. Another thing I want to talk about is the bond market. So the treasury market, I just pulled a rate chart. This data is all from Schwab. Both the stock market information I pulled is all Schwab research data, which thank you to Schwab, Charles Schwab, my custodian and research platform, trading platform. You guys do an excellent job. But I pulled a rate sheet, just taking a look at treasuries, and let's run through some of these so that the audience knows what treasuries are paying. So the 3-month T-bill treasury note is paying 5.39%. The 6-month is paying 5.371. So slightly less than the 3 months. So that still means the yield curve is inverted. 9-month, 5.243%. So slightly less even from the 6-month. The 1 year is even less than the 9-month. And the 2-year will be less than that. And it just kind of keeps trending down all the way to the 10-year note, and 20 the 20-year note's the only time that the yield actually goes back up. So we have a inverted yield curve, which is something that all these economists and people like us pay attention to and care about as far as signaling a recession. So the longer it stays inverted, the idea is that we're likely to have a recession at some point. Well, that's been discussed for multiple years now. So again, getting back to the 1 year is at 5.12%. The 2 year is at 4.65. The 3 year is at 4.36. 5 years at 4.2. So as you can hear this, it's trending down if you could visualize that. The 10 year is at 4.1. So continuing that trend. And then we jump up in the 20-year note to 4.48, and then the 30-year 4.27. So there's a higher yield on the 20-year than the 30-year. Interesting. And that treasury auction did go well, I guess, for folks that I discussed earlier. All right. So tax equivalent municipal AAA muni, for those that care about it, we got tax equivalent yields of 6.211% on that are out there in the marketplace. We're able to shop and bid a lot of these out. We have access to 200 dealers covering 30,000 QSIPs each day and 20,000 municipal bonds when we shop this out. So if you're interested in having Northbound run a bond ladder for you, or a municipal portfolio, taxable portfolio, corporate bonds, or whatever, give us a call. We'd be happy to analyze those portfolios for you and build them out appropriately and manage them going forward to generate as much income and capital preservation for you as possible. And especially, this is going to become especially important for those of you out there that are enjoying cash right now and CDs and treasuries at the banks. Well, party's not going to last forever. So eventually the Fed will lower rates. And when that happens, a lot of the other banks are going to be quick to lower those rates and not have to pay you. And so when that happens, we'll kind of likely, I'm anticipating we'll revert back to the old days where we were managing fixed income portfolios for folks that are higher than what the cash at the bank is going to actually pay you. But for now, take advantage of it, take full advantage of it. I am, certainly. And a lot of my clients are. So we'll just kind of enjoy that as long as we can until it changes, because investments always change and economies always change. All right. That wraps it up. Thanks. I hope you guys got a little bit out of that, and keep tracking the market for you. And we'll talk about all this stuff again here in about a week after the FOMC meeting, probably December 13th or so, right before Christmas. And it'll probably be the last podcast of the year at that point. And then I'll come back in the middle of January, and we'll start up again on these podcasts and sharing information with you guys. All right. Take care, and subscribe the Northbound Wealth Podcast. We really appreciate you. We love you all. Take care. Bye-bye.